is Jonathan Mickles with the Strategic Multifamily Investing Podcast. And today I have with me TJ. How's it going, TJ?
Hey, Jonathan, thanks for having me on. It's going great.
Good. Glad to hear it. Now, just for myself and others, how do we pronounce your last name there?
Korsen, Kosen.
Kozen. All
Yeah,
right. I just wanted to make sure, names are important. So,
sure.
uh, so first of all, let's, I guess, begin at the beginning. How did you get involved in real estate? Because I think you have a very interesting trajectory here.
Yeah, it's an interesting way of going about it, I guess. I started out in 2000, end of 2005 doing loans, saw what was kind of going on in that industry, thought, this is kind of weird for the residential space. Let me look at something maybe more stable, more cash flow oriented. Started to look at multifamily actually in 2006. Closed on my first deal, which was 112 units in June of 2006. So that was fun. We bought it for what seemed to be a pretty good price at the time. Not to be out, it was 10% occupied when we bought it. We recapitalized it over the next couple of years and brought it up to I think about 90 something percent, I'm not sure, economically occupied. And then my second deal was actually 98 units, not to be outdone, I guess, with the first one. That one was more stabilized. It just needed the management streamlined, all that good stuff. So we bought that one with a bridge loan, refinanced it, and then just kind of, sat on it for a while. The only problem with 2006, buying all that stuff, was 2008 was like right around the corner, and I don't think anyone knew quite how big a deal 2008 was going to be. So, and we didn't either at the time. That's the cool thing about going through something like that. So we're just kind of chugging along, and then I don't know, our vacancy starts to tick up, our rents start to decrease to keep up with the market, and then the rest of the sub-market is kind of going down, and we find ourselves as like the best property in a kind of crappy neighborhood. Like, well, shit, we should probably get out of this stuff. And it turns out there's a lot less liquidity at the bottom of the market than at the top of the market. So it was a fun experience. I think we got out of stuff about 2010 or 11, somewhere in there. Um, and it was a fun trip. It was a good time to get started, I guess, in real estate. Uh,
Oh, that's a lot, and I have a lot of questions. I want to run way back, if you will, to the beginning. Mortgages. How did you get involved in doing mortgages back in 2005, I guess?
Yeah, kind of second half. I just graduated college. I didn't know, just kind of dumb kid, I guess. Didn't know what else I wanted to do. My dad worked in like, finance and accounting. It's like, I don't really like that kind of stuff. I kind of like sales. Don't know a whole lot about sales, being, 20 something, whatever I was. But it sounds like fun. All the guys are saying you can make a lot of money, show a couple paychecks. That's how they used to sell it, right? Hey, join our company. Here's the paycheck of our top producer. Like, well, shit. I mean, he's kind of an idiot. If he can do it, it can't be that hard. And
But
then
these
shit
were
got
residential and not commercial.
no, residential. Yeah, residential, doing a lot of refis, a lot of VA streamline loans, a lot of just what was popular in the marketplace at the time. We
Was it
didn't
this,
do.
this was the time when you didn't have to have a license necessarily to do a
That's
loan,
right. Yeah, that's
right?
right. That's right. You had to have a broker, I think, that you worked under, I think.
Hmm.
But to be honest, my knowledge is pretty rusty about it because I was just answering the phone and doing my job. So I'm not sure what all the legalities were at the time. I mean, I know we were compliant, but it was definitely a way different industry.
Yeah,
Uh, and again,
because
we didn't do a lot of bad loans, what I would qualify probably as bad loans, but I saw a lot of just what was available in the marketplace. And it's like, I don't know if I want to be in this business that much longer. There's a lot of kind of shade out here. Let's get into something way more long term and established, like cash flow real estate. That sounds way more intelligent. So that's
yeah.
that's how that kind of came about.
No, I certainly get it because I used to originate around about that same time. So I was
Yeah.
originating residential loans. So I understand what you're saying is that there was a lot of stuff that was out there. So your first deal was a commercial property at a
Mm-hmm.
hundred units. I mean,
100, yeah.
you took the whole thing down yourself. I mean,
I
eh,
mean, more or less. I
okay,
raised it.
how much was that, if you don't mind me asking?
Well, that's the thing. Prices were different in 2006. So it was
Sure.
actually only less than 900 grand. So it was like 870 or 880 or something like that. It was cheap per unit. It was
Very
like
much so. What
something
market
like
were you in?
we were in Memphis. So it
Oh,
was
wow.
about, I think it was about 6 grand a unit, somewhere in there. I don't remember exactly. Our
Now,
capitalization.
was it all cash, or did you get a loan on it or something like that? Or
No, I was doing the creative stuff before it was popular.
okay,
So I bought it from a dude that bought a foreclosure package from some old school slumlord guy.
there you go.
There
Okay.
you go. Anyway, so he bought four properties from this dude, and he had a hard money loan on them, and he'd sold. I think at that point he'd sold two of them. No, he actually only had sold one. Anyway, so I talked to him, and he said, "Yeah, yeah, no, the lender might, what do you call basically like the loan wrap or whatever. It was kind of a fun situation. So he was I would say hard money, but he was basically he basically wrapped like bank financing with a local bank that he knew. And it was
Hmm.
all like disclose it to the bank, all that good stuff. So he had an underlying lien with the bank, and then he basically put his little thing on top and
Yep.
let us basically assume it from the seller.
Hmm.
Now I talked to the seller. It's like, hey, dude, why don't you carry back a second here and help us out a little bit? So
Hmm.
seller carried back a second. And we came in with, I don't know, a couple $100,000 down, and decided to
You
get
you
going.
you say we, so this was a joint venture or
Oh yeah.
syndication, or how did you do this? How did
No,
you
we weren't really
structure it?
syndicating. If you're going to lose money, the best way to do that, if you're young, is do it with your family because they'll either forgive you or they'll be like, "Well, that was a lot of fun. That was a good experience. Let's do it again." So
Right.
I don't know if, I think they've forgiven me by now. But yeah, it was a family deal. So I put it together. I raised the money. I talked them all into it being a fantastic idea, and it was until the market just went. So that was
Okay.
fun to get out of.
So, but I mean, if you okay, so you there's a couple of different things here because you said you got with the family, you did a joint venture instead of it was probably what about five of you all in the deal, or so because
Four. Yeah, four.
okay, yep.
Yeah, it wasn't too big.
Yeah, because I think that the rule of thumb for a lot of people who say if you're going to get into, multifamily, joint ventures are good up until about five. Anytime you get over five, then you generally want to go into a syndication or something like that. Again, I'm not an attorney. I don't think that you are, and we're not financial advisors. So please talk to your proper people for that. So you said that it was only 10% occupied. I mean,
Mhm.
that's a huge risk. Generally, most people are wanting to be around about 80% or so, especially if there's going to be a bank involved, right? 80% or higher.
Yeah, it was cheap. It was cheap. It was at the time what was a pretty good submarket. The like even semi-fixed up stuff was going for 25 to 30 a unit, and the stuff that's fixed up well was going well in excess of 30 a unit, at least at that time. So the numbers on that made a lot of sense. It wasn't openly marketed on the MLS or on LoopNet or anything at the time either, so it wasn't well marketed on that side. So I think we
True.
got what most people would consider a good deal.
Why? What?
Um,
But what was going on such that it was only 10% occupied?
Yeah, well, it was a foreclosure, and the guy that got foreclosed on, like I said, kind of a slumlord. I don't know if that's a
Got it.
technical term, but he wasn't the most diligent guy about upkeep.
Wow. So you
So
found,
a
yeah. Go
lot of
ahead.
deferred maintenance. Yeah, it was all the stuff that all the books and the gurus talk about, right? It's the worst property in a good neighborhood, good-ish neighborhood. And well, we should go in there and make it livable and nice for everyone again. So that's what we tried to do.
Got it. And so, how long did it take for you to stabilize that property? I think you said it was about 2 years or so.
Yeah, two and a half, something like that. We went through a couple property management companies. We found out they all sucked. So we actually ended up suing one and putting them out of business. That was fun. And then
Wow.
I basically took over management, moved back there for a couple years, hired direct employees for a lot of the kind of like soft trade stuff, hired the subs for like the electric, the HVAC, and I think the plumbing too. Yeah, I think we hired subs for the plumbing. And basically I just managed it like personally. Back then.
Did you have any management experience or anything on this? Because I mean, this is a lot of, having to learn these kinds of skill sets to be able to do asset management and property management at the same time.
Nah, piece of cake. Just make sure folks collect rent, just hire the right people for the right spot. You got to fire a lot of people to do that if you don't know really how to hire them when you're 24, 25. So you got to go through some folks, but I don't know. I was like in construction, I always like hire fast, fire fast because it's kind of a show me kind of profession. Like if you're hiring for an office job, it's a lot different. You want to make sure they can perform, you want to make sure they don't mess up the vibe and they're right for the atmosphere. You want to make sure like their qualifications are a lot more important. In construction, you say you can do a lot of crap. That's awesome, bro. You can start right now. Go show me if you can actually do it. If you can do it, that's cool. If you can't do it, hey, guess what? I'll pay you for today. Don't come back tomorrow. So it's a lot easier to figure out on the construction side. The management on the property management side definitely took probably more finesse. That's where we had hired two property management companies. They both sucked. One's no longer with us thanks to me. That was fun. But so we just actually we got our best property manager when we bought our second property because we inherited a great property manager with that property, and her daughter was looking for a new job, and then she came over to help manage the rehab and the lease up of the more distressed complex.
Okay,
So
so you still were fixing the first one while you got the second.
Yeah, we bought the first one in June. We bought the second one in December
Oh
or
wow,
January.
wow,
They were good deals. The numbers made sense at the time.
got
At
it.
least
So
we thought they
you,
did.
I got you. So the second one, you also went back to family and said, "Hey, let's pull together some money to make that one happen again," or had you already capitalized
Yeah,
the
no,
existing one?
that's yeah, same kind of thing. So that one, actually was the same seller because, like I said, he had
Ah,
the four property package. So I kind of got to be friends with him. He wasn't a great manager guy. He didn't, I don't know, he bumped heads a lot with people and didn't let them just like do their job. He was kind of a micromanager, I would think. So I kind of made friends with him. I saw him sell. I think he sold one before I bought the first one, so I bought the second one, and then he sold the third one, and then I bought the fourth one. So he wanted out, so I got a good deal. And again, I made him actually hold back a small second. I think I did on that one. I don't remember. Like really small though. Assumed the same lender as the underlying, and then we refinanced out of that one. We had to stabilize the occupancy and get it up a little bit and like kind of tuned up a
what
little
was
bit
the
better.
stabilization percentage? You were what,
I don't know,
80% before you?
87 to 90-ish, somewhere in there. I'm not sure
Right.
exactly.
Okay.
Yeah,
Cool.
we're going back in time, so I don't
Yeah.
know exactly.
Yeah. No. 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 It's cool. It's cool. Because I'm just saying, traditional money generally, you've got to be at that higher percentage in order to stabilize the.
Yeah, it was still we refinanced out of the hard money and again, say hard money, but he was actually adjustable. And at the time, 2006, I don't remember when they started lowering rates, but they probably helped us and hurt us because they started dropping rates and he was adjustable. So when prime went down, he went down with prime. So it's like, well, shit, that's actually a pretty good rate, which was cool.
Yeah.
But it also meant that we weren't quite as proactive about like, ooh, this asset's maybe in a declining neighborhood where we want to get out of it as fast as we should have been at the time because, well, shoot, we're still cash flowing. So
Delaying the
not a big
pain.
deal.
Hmm.
Yeah, exactly. So there's kind of a give and take, I guess, with that. The second property we refinanced entirely. I think it was basically a bridge to perm loan. So we did like a short-term bridge loan to like more maximize occupancy.
Hmm. Hmm.
Um, and then they had a small holdback once we showed them updated financials with new lease numbers,
Right.
new, expense numbers, that kind of thing. Then they rolled it into a relatively perm. I think it was still like a 5-1 arm.
Right.
Um, that bank, that bank, unfortunately did not make it through the crash. It was tragic of theirs.
I would ask you the name, but I don't. I'll leave it there. I'll leave it there. Um, so then you did the first one. You did the second one. Did you purchase? I think you mentioned you could purchase a third multifamily, or was that the time that you kind of pivoted into, residential fix and flip type
My third
business?
deal was a burnout house, so that was fun. So that was just a kind of distraction, I guess. No,
It
I
was a
pivoted kind
okay.
of a distraction. We've done a couple small multifamily things since then. We mostly right now do a pretty high volume of single family. I like the space. We're really good at it. We like the turnover. We like the liquidity. And it's a fun place to be in. And getting beat up a little bit in 2000, I don't know, 9 to 11-ish. It's
Right.
like, yeah, I kind of got it out of my system, at least for a while. And then as the market started
You
like going
got beat.
crazy,
Hold on. You got beat up on the residential.
nah, no, not the residential. On the commercial, when we got out of the
Got
first
it.
one,
Got you.
we took a hit on the first one. That's for sure.
Got
Uh,
it.
that wasn't fun.
So that was the reason for having to pivot, is that you were getting beat up on commercial. You said, "Look,
Yeah,
let's just go into residential." Okay, great.
yeah, and it was a different environment. So it's a buying opportunity when everyone else is selling. But if you have to sell, you're not really in the mood to turn around and rebuy stuff. So I was like, let's look at something else. Let's look at houses, get in and out of them. It's not that hard. It's way easier than like trying to renovate 100 apartment units all at the same time. There's a little different structure in terms of obviously like who you're employing because you're not working on the same kind of like scale. Doing one house at a time was a lot different than doing, we were renovating 8 apartment units at a time. So it's a little different in terms of that. I definitely had to relearn a bunch of the stuff that I thought I knew getting back into residential. And then I had to
Interesting.
relearn just the project management stuff. Uh, Kind of went to doing a lot of the like some of the stuff myself. So that's always a bad idea because I can do that. That's easy. It's just on a house. Um, you can't do that with apartments, right? You can't do that if you're renovating 20, 30 apartment units. Or in our case, 100. I can't paint that much. So you're forced into scaling. So anyway, so houses it took a while to figure out how to scale the whole thing because there's such an individualized asset, at least in my mind, for where they're at and what you can do with them. You got to fix it to the neighborhood, you got to fix it to the price point, you got to fix it to the comps and all that. but there's not like a uniformity with it quite so much.
So
So
did you hire a team? And initially, it sounds like initially you did some of the work, but then you
I hired a
scaled to
couple
a team.
guys. Yeah,
Okay.
hired a couple guys in San Diego for kind of licking my wounds. I surfed a lot, kind of like, man, that wasn't fun. So I licked my wounds a little bit for a couple years, did a bunch of houses in San Diego, but didn't really know the volume game out there. That's where I'm from. Anyway, didn't really know the volume game in real estate. I didn't know folks that were doing any kind of residential volume to speak of. I'm sure there were. I just never really bumped into them going to networking events or whatever. It was always folks that were kind of onesies and twosies. So got married, moved to Dallas. Thought, stuff's cheaper in Dallas. That's cool. Lifestyle looks like it's fun. If it turns out I'm actually really bad at real estate, not just bad at timing the market, then I can always get a real job, I guess. Uh, I don't know. Probably couldn't. But anyway, so my wife and we got married, we moved out here, and thought, oh, this isn't that hard. So it took us a while, but we definitely scaled up. We have a nice little team that does pretty much everything. Like, yeah, I'm at home today because it's Monday and I didn't feel like going to the office, but we got like 10 guys down there actually doing work. So
Oh,
that's nice to have.
yeah, yeah.
And
That's
then
really good.
so I guess what like made that work was taking kind of a commercial mindset to residential properties. So definitely more volume based, where it's like, okay, now what's our where are we making money? Well, we're making money on buying volume and selling volume. So how do we do that? Well, we got to hire people to buy stuff because I can't do everything myself. We got to hire people to sell stuff because, whatever. And then if we do fix and flips, which we do a good percentage of, I suppose, then it's pretty obvious we have to hire contracting crews that are just more self-sufficient and capable of handling a job in, something that might be 45 minutes or an hour away from here. So
So you don't directly employ your own contractors, you hire that out.
yeah, we
Um,
hired that out.
and then the
Yeah.
people that you have to sell, those are real estate agents that you're working with, right?
Yeah, then more or less. So we have an internal team on the acquisition
Okay.
side. We have three people that buy stuff, and we do the lead gen and the marketing on our side.
Right.
They do the negotiations and all that. And then I think my wife's the only one.
Disposition.
Yeah, I think my wife's the only one actually licensed. So she still lists the stuff that hits the MLS, but we sell most of our stuff, probably 60, 70% of it off market. So we're selling either the contract or we do a lot of seller financing where we originate our buyers directly via basically internal sources. So kind of old school ways, really. Bandit signs, Facebook groups, that kind of stuff. We get seller finance buyers. So we have two girls that are on that, and they do a lot
Are
of the
these
negotiation on that side.
these are lease option type things then, or
Yeah, more or less. It's not really a lease option because we can't. It's tough to do in Texas, and it's really tough to do like
yeah,
a sandwich lease option. So no,
yeah,
it's generally properties we take down, we own, and then we just offer seller financing when we go to dispo of the property. So we don't, we have like, I think we have one lease option, and it's compliant. You got to have it under 12 months or 18 months, or I don't know. So whatever. So we do that, but I think we only have one or maybe two. Most of them are seller finance notes, and it's
so
just a nice little niche that we found ourselves in.
so seller finance knows. I mean, that's a lot of money to actually be holding and figuring
Yeah.
out who you're, who's going to actually, perform, et cetera, the portfolio. Because I mean, you're actually, the bank in that situation, right? Where most people would
Yeah,
probably want to just get a check and be in and out of that particular deal.
well, we like both. It's all about other people's money. So we have a couple rich guys that we sell the notes to. That my business partner has been in that game for a long time. Actually, he's been in that game as long as I've been in all these different pieces of real estate. So we'll play with them. We can sell at face value depending on the property because we originate a relatively high interest rate. So we have a couple guys that'll buy at face value just based on the rate and the terms and the down payment. If the property is a little less habitable than desirable. Maybe it's a bit of a turd, but it's got some meat on the bone for the buyer, and they want to do it for an investment or something like that. We got a different guy that'll buy those notes. So we recapitalize that way. If we want cash flow, we'll either once in a while we can discount the rate a little bit to the end buyer, but not usually. Generally, if we want cash flow, we take a second on the thing because we
Yeah.
always get a down payment. We're always getting 10 to 15% down. We're always getting insurance and taxes paid in advance. So we're not giving away the properties for someone that doesn't have any money. We're qualifying the crap out of the buyers.
Yeah, I mean,
So
if you're putting 10 to 15% down versus a FHA, generally you're putting down three and a half
yeah,
percent, right? Or
yeah.
5% for, a Fannie Mae, in some of those instances. Yeah.
Yeah, so we'll keep a second, maybe sometimes for cash flow. We have I'm not even sure, to be honest with you, I'm not even sure because sometimes the lender just wants us to do it for more of their security for the first. So it was a couple weeks ago. I sat down in the office and said, guys, how many seconds do we have out there? And they're like, I don't know. But yeah, I don't know either. Because we did a lot in the last couple of years and they, keep coming in. That's cool, but I don't really know where they are and what the balance is on them because the first usually services them. So I'm like, guys, figure out something in the CRM or somewhere. I don't care. Like add all this shit up and let us know. Let me know where it is, just
Right.
so we know. So if someone defaults, we don't have to like remember where it is. So
Right. And then you're
anyways,
gonna have to
so
discount your stuff by 90% anyway, right? If
no,
the
well,
person who gets the
benefit of
second
that
is
is
no.
the benefit of that is we're selling the first to guys we know. So if they have trouble, they'll call us before they go and foreclose on the thing. And then we would probably know if they're defaulting anyway. So we always say if we're selling
It's
on those terms,
so if they're calling you for help, then you know that something is about the default. Do you all assume the workout sort of situation in that situation, or how do you work out?
yeah, ideally. So I don't think I think we have one. It's a little squirrely, but they're getting caught up. So generally we tell the lender like, hey, if there's an issue, we'd rather foreclose on our side, let you, and then we'll start paying you, and then we'll just resell the property again. And for the most part, they think that's a pretty good deal because if we sold it once for that price, it's not like we're in a declining market on those properties. Um, yeah, I don't think so. I mean, maybe might be one or two that's come down a little bit, but not to speak of. We're in a pretty stable market here. Then we'll just resell it again, and we'll collect another down payment. If we need to hold another second, we'll hold another second.
Right.
If we sell the first outright 100% and they have a problem with it, maybe we don't know about it. But even in that case, we're usually like, hey, let us if that happens, let us know and we'll help you out and try to sell it again because
Right.
they're lenders are not sales guys. They're not the best at originating their own end buyer. If
Right.
we're good
And
at that,
yeah, and
let us
again,
do
these
it.
are private lenders that you're working with. These are people
Yeah,
probably that have their own self-directed IRAs and stuff like that that have money to be able to use and create notes with, et cetera. That's
yeah,
another. Go
yeah.
ahead.
They're guys that are in the business, so they know real estate, but they're not buying and selling houses anymore. They probably have a couple hundred houses and they just want to park some extra cash somewhere.
There you go.
So we're not really raising money for that because we have guys that'll buy our notes that way. We're in the process of putting together a fund for kind of cutting them out, but
Oh,
we
okay.
don't really know if we want to talk to 100 people that have 100 grand with us. Sounds like a lot of work, and we almost like just moving the crap out of some houses.
So you're going to put together a fund to do what? To be able to lend first on your own stuff, or
Yeah, probably. Yeah, we're in the
okay,
process of we're working it through. We're kind of on the fence about if we're going to pull the trigger,
got it.
talking to the attorneys and all that good stuff. But yeah, I mean that's one way to I guess make more cash flow. We
So
like that better than we like rentals, at least in the residential space. We have a handful of those, and they're all a pain in the butt. Like every single one of them is a pain in the ass.
So over the last couple of months, 18 to 2 years or so, we've seen interest rates, climb like 11 different times, right?
Yeah.
And so, we're in the process of potentially, at the beginning, at the time of this recording, reducing rates over time or whatever. But how does that impacted your business, and what do you see going forward? I mean, how do you see the landscape going forward, specifically in the residential space?
Yeah, it's changed a lot of things, and we saw it coming relatively quickly. I mean, the one thing that I like about this Fed, and let's be honest, they're not the smartest people, but they at least are broadcasting what their intentions are. So I went to college when Bernanke was Fed president, I think, and it was always a big secret, like what was going to happen. Is the Fed going to raise rates, lower rates, stay the same? What are they going to say? Like he was a big old secretive guy. Like he wanted to not tell anyone what's going on. And I don't know if it's better or worse like this, but for our industry, the Fed is pretty much telling people what they're going to do. Like, here's our target with inflation. Here's what we're likely to do for the next couple months. So when they started raising rates, like you said, 11 or however many times it was, they've been talking about it for 6 months. So that gave us a lot of prep. What we told people in our mastermind was, hey,
Mhm.
all this non-QM money that you guys are getting for rental refis and all the stuff that we took advantage of. We got a lot of money, refined that way. All this is going to go away, and we said it in like February of whatever year that was, 2 years ago. By June, that industry was completely different. A lot of the big players had closed up shop or tightened up or just changed in a big way. So that's a big thing that we kind of saw coming. I think we expected there might be more of a price correction across the board than what we saw in the residential space. So we tightened up on flips because
Okay.
market exposure for time in the market, at least especially on flips, is just very risky in our business. In addition to all the like regular risks of flipping real estate.
Generally,
So we didn't.
how long does it take for you to flip? Is it about the 3 to 6 month time frame?
Yeah, I'd love to say it was 3 months, but our record is like probably 6 or 8 weeks, and our average is actually about 6 months when we look at all the KPIs. There's
Right.
a couple that are 3 months, and there's a couple that are 9 or 12 months.
Right.
So,
3 months to
so
acquire and renovate, 3 months to potentially sell.
yeah,
Yeah.
for the most part. So we um lost money on one, I think maybe two. I know one for sure we lost like 20 grand on. That kind of sucks. But before that, we were selling everything 20 to 40K over ask. And so we
Well,
knew that wasn't going to last forever. So
yeah.
like, okay, let's tighten up on the flips. Let's try to reduce our market exposure. So what we're doing now is we're wholetailing a lot more. We're wholesaling a lot more. We're where we are just a signed-in contract. We're doing a lot more of the seller financing, where there's always a big piece of the business, but it's probably quite a bit more than it was 2 years ago. Where interest rates are affecting us, I would say they did affect us negatively for a while, was we had to raise our rates on seller financing.
Mm,
So if we're going to sell the note, it obviously needs to be at a premium above what a lender is going to charge if the one exit strategy is if you're just rich, you just put down money on the note and you cash flow the note. That's a great exit strategy.
right.
But if your risk-free rate of return is 5 or 6%, and if your relatively risk-free rate of return, if I'm just sticking my money in like a hard money lending fund, most of those are probably 10, 11%. Well, they want to see a premium above that. So we were originating notes at I don't know,
15?
high
Okay.
tens, I think, 2 years ago. And now
Uh,
we're originating at like 12 and a quarter. Nah, 12.9 to 13 and a quarter.
yeah.
Um,
Okay. All right.
so we've had to raise our rates. And that's, kind of adjust to the product that we're really targeting, what we're able to buy, how well we're able to sell it. You bump into different hurdles where you're competing
So
against rent.
so
You
that
compete,
13, that 12, 13% is not considered usury on a long-term thing because you're amortizing over 30
no,
years, right?
no, not in Texas
Okay.
anyhow. Not in
Yeah.
Texas.
Okay.
Um,
Okay.
not in Texas, and about 40% of the loans are investment grade anyway because the properties are not livable. So we're selling to an investor that maybe wants to keep it for longer term cash flow, that wants to provide some sweat equity and kind of fix it up themselves, that wants to rent it out or let a
Okay.
family
So
member
I
live there.
I was under the impression that you were in your seller financing to the end buyer rather than
Well,
to the investor.
we generally are, and they generally keep them. I wouldn't say they term them out for like 20, 30 years, but they keep them for quite a while. They're definitely longer term. 7 to 10 years is a kind of average hold time on a lot
Right.
of them.
Right.
And there's a percentage of them that go through the RMLO and go through the entire underwriting process. And those are kind of the highest end products, I guess. Those are livable. We do a light rehab to them. Um,
That's
the
that
person,
hotel option, right? The
yeah,
light
more or
rehab.
less. Yeah. Yeah. Wholesale to seller finance is how we do that. We're still selling the notes to relatively the same types of investors if we sell the notes. So we got to make sure the interest rate, fits their criteria. Um,
I've got two more questions. One on the qualification side, and then one kind of another future one. I'm sorry, you when you're talking like this, yeah, I could hear there's a lot of things. You mentioned that you qualify the heck out of those who purchase, who are going to be purchasing, down the road and living in the properties. I assume, right? That's how
yeah.
you're doing some of them. What are some of the criteria that you're looking for when you're qualifying those individuals, say, who are going to purchase the home to live in?
Yeah. So relatively similar. It's more about the documentation for regardless of if they're going to be a long-term um, seller finance loan, then the qualifications are pretty similar. It's more the documentation about owner occupied versus non-owner occupied that makes the determination about whatever. So if it's going to be not owner occupied, we're going to verify that they're not going to live there
Right.
because we don't want to get into trouble that way. So
That's right.
we do that by seeing if they have another house, by putting an LLC that they own, by whatever
Yeah,
it might
because you
be.
can foreclose on an LLC a lot faster than you could
Yeah, exactly.
own a rock. So
Yeah.
then for owner
So we're
occupied is,
so
I guess, my focus. Yeah.
for all of them we're getting 10 to 15% down, and we'll only override that if we're really comfortable with the property. And because we got to be able to sell the note, so we might take 7 to 10% down, but then we know we're going to be stuck with a 20, 30K second, which is not bad. But you know, it works.
The price points that you're selling these at, or where are you
Mm,
in the price points?
250, yeah, 250 and below. Our sweet spot is buying sub 100, selling sub 200. Um, but I think our, yeah, 250 to 280 is kind of the
Okay.
price point that we're doing a lot of these things in. Um,
So they've
we gotta
got
go
10% down, that's 25 grand. So they have to have 25 grand coming to the table.
25 grand plus they gotta have, 1,500 bucks for insurance. They gotta have 3, 4 grand for taxes, prorated or whatever. So they're putting down a chunk. So I mean that's a huge qualification. If they don't have the chunk to
Oh
put
yeah.
down, then they're out. And we can anyone can sell seller finance with no money down. But I was doing that in 2006, and look how that went. It
Well, I mean
wasn't called
that,
seller finance; it was called Ninja.
but I did. Yes, yeah. And the Ninja and the Nina and the Pina and the Santa Maria. I think
So
it
like
was
we
two
don't
of them.
want that to be our business model. I know a lot of folks
Yeah,
that do that.
yeah.
I'm like,
But
bro, that sounds risky to me.
yeah,
Well,
but
how do you get them? How do you
do
get
you have a
10%
lot of
down?
but do you have a lot of people at that? I mean, that's 30 grand. Do you have a lot of people? People beating down the door that have 30 grand to jump into your homes, or
Yeah, yeah, pretty well. We
wow.
price them relatively competitively. So we basically originate our own internal list for that. We're not
Mhm.
finding people that are, retail level investors.
Understand?
I'm not selling to my competition with those products. Now we'll wholesale to our competition, and
Right.
sometimes they do really well on it. We just sell because we don't want to deal with a rehab process or whatever, because we're overloaded or don't have the cash to do one, or just it doesn't fit a box that we really care for in that house.
Got it.
So we're really going out to originate buyers, and so we have a bunch of folks that have bought multiple ones from us. That's pretty cool.
Wow.
Um,
On
but we're
the
doing
investor side, or on the
Yeah,
single family, owner occupied
um,
side?
on the seller on both really, because it's basically
Okay.
the same. It's basically the same loan terms. Um,
Okay.
it's the 12 to 13%, 10% down minimum, ideally more than that, and full term. So we messed with the amortization a little bit, 20 to 30 years. That was pretty standard in that kind of space.
Sure.
We really only compress it if there's some other factor like why we should compress the amortization.
Hmm.
Maybe the seller wants to pay it off faster and they want to be forced into that position. Like, oh, I'm not going to tell you got to take 30 years if you don't want it. I don't care.
Right.
So so we just market a lot for that.
Wow.
We sell on the Facebook groups. We sell on bandit signs. As funny as that sounds. We actually done a couple deals, acquisitions from bandit signs too. So we'll drop like 100 bandit signs. We'll do like 30 in English, 30 in Spanish, and 30 for we buy houses. And we'll get our own list of folks that are just a lot of looky-loos and stuff. But it works well. One of
Well,
my
you've got a
crews,
team. You got an acquisition team that sounds like second to
yeah,
none.
yeah,
You know.
they're all right. Don't give them big heads. I won't let them listen to this podcast if you start.
Well, I'm going to give you guys your props. I'll give it. I'll give it to them for
Yeah,
them.
they're well trained. They're well trained.
So my last question here is about the future. You mentioned San Diego. I recently just saw a YouTube video. It was another real estate agent slash investor who was talking about the most recent floods that were happening with the what do they call it, atmospheric rivers, and how much rain San Diego was happening. Was happening there. Are your properties there, or are you primarily just in Texas right now? I mean, where are you focused there?
Now we'll wholesale in different markets. We have some stuff in Arkansas, Georgia, Florida. In terms of stuff that we're buying to do anything with, it's all in the North Texas area. We played around Houston some, but we just didn't like the market that much.
Okay.
I have one rental in San Diego. My parents have a couple. All their stuff's fine, I think.
Okay.
Um, but yeah, it's kind of weird, right? I need to talk to my dad.
Yeah, I was about to say what's going on with the insurance. That's my concern there is, what are you seeing as, you know, some people say there is climate change, there isn't climate change, but we're seeing insurance companies responding at least
Well,
and
we're
to
definitely we're
some of
definitely
this.
seeing that in Texas. We're definitely seeing that in
Okay.
Texas. There's been a lot of kind of ever since the big Houston storm where downtown Houston was underwater.
Right, exactly.
What was that
Yeah.
3 or 4 years ago?
Hmm.
We've seen insurance just go up from there. I don't know if there's more hailstorms now than there were 10 years ago or not in Dallas, but we're definitely seeing insurance carriers between Dallas, just drive up rates, go from, a 1% deductible to a 2% deductible on everything to a 3% deductible on like roof claims, that kind of stuff. So that's always, I mean, fortunately we have our own subs, so we're not trying to make money on insurance. We're just trying to make sure we don't lose our butt if something happens. So we're more immune from that than maybe the mom and pop landlord that has 5 rentals and needs to call Joe Roofer out of the phone book. Um, but yeah, it's definitely a factor.
So
One thing that's more
do you use an umbrella policy, or do you get separate insurance policies on each of the properties that you guys are owning, especially if you're holding them for a long term?
Yeah, for our stuff, we get just individual policies. I think we looked at umbrella policies, and the overall wasn't that much cheaper or different.
Okay.
But and again, like I said, I don't actually I'm not in love with residential rentals. They're hard to scale. They're hard to manage. The turnover ratio is binary. You're either occupied or not. So we're not in love with them. I mean, we have a bunch, but they're kind of a pain in the butt. And the one big factor that affects them, I think, um, more than commercial, especially in Texas, the property taxes. Uh, this out here they stink. Like the property taxes in Texas are not great, and basically the municipality can just make it up on the fly. So there were properties that we had where our tax rate went up 40%, 50%,
Wow.
over a year. So then you go back and contest and argue and threaten to hire an attorney, and maybe you drop it back down so it only went up 30%. Well,
That's
it's
still
awesome.
30%. Yeah, I
It's
mean,
still 30%, and it's great if you want to sell, which we've offloaded a couple because like, yeah, this doesn't cash flow on that good anymore. But it kind of sucks if you're trying to manage what your actual cash flow is on the things. They're great wealth. I guess they're great wealth kind of preservation or creation over the long term, but just the cash flow sucks.
so then moving forward for your company, this is my last question here. I could talk another 30, 40 minutes, but I know you've got time, things to do. But for moving forward, where are you looking right now? What's the trajectory of you and your company, and all the things that you're doing? Because you have multifaceted. You're not just, oh, we're residential. You're, wholesaling, hoteling, fix and flip, rental, uh, notes. You're doing a lot of different things here.
Mhm.
What are you guys doing moving forward? Is it more of the same, or do you see a different trajectory?
No, I think we're on the right direction. We're definitely on the right trajectory. I think it's definitely the case is you always bump into issues trying to push the velocity, any fashion you can. You got to generate more leads to hire more people. You got to hire more people to handle more leads. So we have a good solid team, like you mentioned, on both acquisitions and dispo.
Hold on.
This year,
Could you do what? Can you repeat that for your team?
yeah, well, they're all right. Anyway. No, so they're good, but we're definitely at a capacity where they make good money, but they're not working as hard as they could. So then it's now back on us to make sure they're getting more leads to do more. So we want to try to increase. We could probably have about 25 to 30% more gross capacity in terms of like deal volume and deal flow that we could do with the team that we have before we have to really look at reevaluating stuff. I think that's the easiest hanging fruit for us right now is just do more deals. No, that's interesting because generally I tell people in business, hey, don't focus on doing more deals, do better deals first, and then focus on doing more deals. But we already do all the good deals. Like we already do all the exit strategies. We already do a lot of marketing channels. So we're able to do, pretty good volume. We keep, I don't know, 25 to 35 deals on the board at any given time. So we want to, speed up the turnover ratio on the ones that we have, but we're already ticking them off. So it's not that hard to tick off a couple more, I guess. We like that. We're kind of on the fence about building a debt fund just because of, I probably ought to talk to you about that actually with multifamily and stuff, just because of, well, partly because of the competition in the marketplace. I mean, there's always competition, partially because, like I mentioned, I don't really know if I want to talk to 100 people that I have 100 grand with once a quarter. Maybe they all want to talk to me individually once a quarter. It's like, that's a lot of lunch, man.
You just need
So
an investor relations person, that's on your on your acquisitions team, and you'll be fine.
yeah, but the problem with that is now I still got to sell them, so they still gonna want to talk to me. So we'll probably go that way. But we're kind of slow walking it. We're like, let's focus on, adding 25, 30% to the business that we have, and then take some more seconds for more cash flow. And then, well, I'm kind of lazy. Like, let's look at the easier ways, try to figure out the easier ways to do this stuff.
Got it.
Uh, I end up just working more that way. So I don't know. I'm not good at being lazy.
That's fun. So you have a mentorship program, and I know that there may be some people who are quite interested in how you're doing business. How do they reach out and get in contact?
Yeah, absolutely. It's TJ Cozen all over Facebook and Instagram and all that good stuff. So really easy to find. Our business, like investor facing thing or the education site, is reiaf.com. So we really focus on, I don't know what AF stands for, but REI is real estate investing. Uh, we, we really focus on folks that want to grow their business intentionally through optimizing their lead flow, but really honing in on, okay, are you doing the best you can exit strategy wise for the inventory and the deal flow that you have? So generating more leads is easy, but if you're leaving a bunch on the table by not selling your deals right, by not fixing your deals right, or sometimes fixing your deals when you shouldn't even be fixing them, let's look at your current business model. Let's strip that down and see like, okay, where are you at the easiest path for making more money? Because it's really easy in the education space to just say, well, just do more deals, make more cold calls, send more letters, throw more money in the marketing machine, and you're going to get more deals. And to a certain extent, that's kind of accurate. But if you're doing crappy deals, doing more crappy deals doesn't actually make your business better by doing more because you add layers of overhead. So we're like, well, let's make sure you're doing good deals now, and then we'll work on increasing marketing, and then we'll work on adding overhead, and then we'll work on building the business like sensibly instead of just throwing stuff at the wall and seeing what hits. So that's really what we try to focus on in the mastermind. It's good. Guys like it. It's fun for us. We don't make much on it, but we enjoy doing it.
So then, are there any particular type markets that you like? Which markets do you like that you want somebody to come in, or are you open to all markets? And then it sounds like you want someone who is not necessarily a beginner, but maybe intermediate to advanced is probably a good match for your program. Please correct me if I'm wrong here,
No,
Mark.
that's absolutely right. We don't mind the beginner, but we tend to have a lot of turnover with those because mostly they're wanting to wholesale, and we'll say, okay, wholesaling, that's great, that's awesome. We'll teach you how to do it if you don't know how to do it, but there ain't nothing special about it. Just do more of it. Like sell a little bit better, buy a little bit better, and you'll make a little bit more money. We're really more about the people that don't really know if they want to scale, which is fine. Like I don't think everyone does, but we're the mid-level kind of guys. The guys doing one or two a month, maybe they want to do three or four a month or five or six a month. There's one or two guys in the mastermind that are doing more deals than we are, which that's always awesome because they'll come in and talk about what they're doing. It's like holy crap, that's incredible. But they like the community and they like the marketing feedback because they know we're doing a lot of stuff too. So it's easy to see like kind of compare notes on what is and isn't working. We're definitely very much in the business, like it's the main revenue generator of the business is the real estate. We're not some of the guys that like, oh, I want to do education to get out of real estate. They never start saying that, but they always kind of go that way anyway. We like doing the transactional aspect of the business. We think it's fun. We're good at it. It's what the team is built on, and we like having the team.
Gotcha. So for everybody listening, most people that we talk to start, in residential and then grow to commercial. I think this is the first time I've ever talked to someone who started commercial and then went to residential. So there are all kind of paths that anyone can take. Please reach out to TJ and his team, especially if you vibe with his knowledge. They're doing a lot of different things, not very very simplistic as we've seen some models that are out there, and it's really good because I think that with all of those different avenues and ways to scale, you won't be bored, and obviously you will get pushed to be optimized here with TJ and his team. So TJ, we'd like to ask one last question for everybody who's a guest here, and that is we want to give people the boot. There we go. I pointed to it correctly. So we want to give them one piece of advice that you have that you think that will spur them on to take the next action in their business and next action to learning, next action period. What thing would you say as the piece of advice to give people to boot?
I think there's two. The most important ones, Larry Ferry, is think of what's important in your life and build your lifestyle around what's important. Ideally, in my opinion, that revolves around faith or family and a combination of those two. As we build our team, we find it revolves even more and more around making sure the team is able to perform and able to be successful underneath the umbrella. If we hire someone that isn't able to perform and be successful, a big piece of that failure is on us. So figure out what's important. And if that's important, I think that's important to build. The second one is definitely don't be afraid of failure because You can't, if everything's easy, then you're not pushing yourself hard enough. And that goes all across the spectrum. If the market changes, the market changes. Try to see it coming, but a lot of other people in the same boat when that happens. Uh, Stuff goes wrong. It's the nature of the business. If stuff's not going wrong, you're not pushing the envelope hard enough to figure out what can go wrong to push through it. So failure and setback is always part of the thing. Just make sure that make sure you're covered. Make sure you're still have an eye on what actually is important in your life and in your business.
That makes sense. But listen, TJ, thanks again for everything. And again, if you are interested in moving to the next level, please reach out to TJ. They've got some amazing things happening over there. Thanks so much.
Thanks, man. Appreciate it, Jonathan.